In this lecture, we'll discuss business valuation. Value is an interesting concept. What is something worth? Anyone who has ever bought or sold something knows that the buyer and seller have differing opinions on this. So a big part of value is based on perception. Understanding the circumstances in which the business is valued is necessary. So, for example, when the balance sheet or income statement present the business in terms of a value, it's up to you, the user of that information, to be clear about how that value was determined. So when determining a business valuation, there's three elements we need to consider. First of all, we're going to be making a forecast. We're going to be guessing, estimating, however you want to say it, what future earnings are going to be, what the business is going to be doing operationally in the future. Now there is a risk to that, and one of the key risks is that the estimates that we make are not going to actually occur. And also we need to take into consideration the present value of the estimates. In other words, if we're estimating that a business is going to earn money in the future, we want to know what the value of those earnings are at this point in time, at the present time. So in order to do that, we're going to discount future earnings using the time value of money. There's different ways we can approach this. One way is that we can look at pure cash flows. When do we expect the cash to actually get into our bank account, or when do we expect to use the cash up? The other way is to look at this through the accrual basis. We talked about that in previous lectures where we considered the cash basis versus the accrual basis. Well, if we use earnings based on GAAP, that takes into consideration accrual basis accounting. And then finally, fair value. What about looking at the business at a fair value, meaning what the business is worth at the current time? If we approach this from the cash basis, let's look at an example. We have a business venture where we're going to do rental trucks. So to launch this business, we're going to buy 4 trucks at $20,000 each. So those 4 trucks are going to be paid for all at once at the beginning. So we're going to use up $80,000 in cash right away. Then each of these trucks is going to bring in $5,000 in cash flows each year. So that's where we get the $20,000 in year 1 and year 2. And in the second year, we're going to buy another truck. And so that's going to bring in another $5,000 in cash flows from that point on. So for year 3 and 4 and 5. So the cash flow is going to be generated in each year at $5,000 per truck, $20,000 in the first 2 years, $25,000 in the last 3. We're going to use up cash when we buy the truck in year 2, the additional truck in year 2. And then we're going to sell off the trucks. We're going to get out of this venture at the end of 5 years. We figure we can sell the trucks at $6,000 a piece. So that's going to bring in an additional $30,000. So we see our future free cash flows coming in year 1, $20,000, in year 2, 0, because we're bringing in money, but we're also using it. And then it will remain constant at 25 until we get to year 5, where we bring in more cash from selling off the trucks. So one of the problems with the cash method is that we need to remember that present value of cash is different from waiting for cash to occur in the future. So we need to discount future cash flows to get to a present value. So we're going to use the present value tables of a single sum. To do this, we're going to use the cost of capital at 10%. So cost of capital can be thought of in 2 ways. Either it's the how much we're going to pay, a bank or a lending institution for a loan, or it could also be considered how much we expect to bring in as a return for our investors. Investors don't give money away for free. They want some kind of a return. So a minimum return of 10% would be the cost of capital in this case. Either way, it's 10%, and we use that in our present value tables, and we get the following present value factors. And so this discounts the money to a present value. When we add all these up, the present values total $88,191. Now the initial cost to get into this business, we said, was 4 trucks at $20,000 each. So that means the initial cost is $80,000, so that would come out of our pockets today. And then the present value of the future cash flows would be $88,191, and that gives us a positive net present value. Cash flow model is useful But another way of looking at this would be using the financial accounting rules through generally accepted accounting principles, or GAAP. That's basically using accrual basis. We can generally consider accrual basis accounting information to be better than cash basis. And some of the reasons for this is that it matches the resources that are being used up with the resources that are available in the current period. Let's look at this example that we just did with the cash flows, and we see that the cash is kind of lumpy, right? It comes in spurts, it goes out in spurts. Because the accrual basis smooths out the revenue and the expenses and matches it into the time period in which it is utilized, it's generally considered a better methodology. Another thing accrual method can help us with is understanding the quality of earnings, right? So this is an example of a financial statement from Columbia Sportswear. And so this income statement shows us the revenue and the expenses. And it puts it into different categories where we can understand sustainability versus non-sustainability. The sustainable earnings are going to be those that come from repeat customers, steady consumer demand. The non-sustainable earnings would be from things like restructures, retirement of debt, write-offs, reduced spending, or something that doesn't have a steady demand. Notice on this financial statement, we can see the income from operations versus income or expenses from some things that are not associated with operations, such as interest. Now let's consider fair value accounting. So fair value accounting is where we adjust the values on the balance sheet to a fair value based on what the market price would be for those assets. So how do you figure out what the current value of an asset is? Well, you could figure it out based on exit price or entry price. Exit price would simply be, how much it would cost to sell off an asset. So let's say we have a warehouse as an asset. If we sold the asset, what would it be worth? And that could be one way of approaching fair value. Another way would be entry price, meaning if we were to replace the warehouse with another warehouse that was very similar, what would that be? It's a different way of approaching fair value. GAAP looks at the different assets based on levels of certainty for fair value. So a level 1 fair value calculation would be something based on a quoted price for an active market for identical, and that means like a twin asset. So the only real example I have is if we had some stocks as an investment in our company. So let's say our company invested in Tesla Corporation stocks. Well, those stocks are currently sold on an active market, and when you buy one stock, it looks exactly like another stock. So that would be a good example of level 1. Level 2 would be getting a fair market value for an asset based on an active market for a similar asset. So take, for example, a building. If you were at a warehouse, you might find comparable warehouses to get a value with, but they're not identical. Nothing's going to be exactly the same. And then the third level of coming up with fair value is based on management's estimate. So that's the weakest of the three. Fair value accounting is important for stock analysis investors and accountants, especially when they're determining something called goodwill. Basically, goodwill is when a parent company purchases a subsidiary at a price that's more than the book value of the net assets. So in other words, they pay more than what the assets are worth. The assets are then increased on the books to get to fair value. So here's an example. We have a parent company going to buy a subsidiary. The subsidiary's assets are worth $45,000. The liabilities $25,000. So the net assets are $20,000. Now the assets based on a fair value calculation would be $50,000. Now the parent purchased the sub at $80,000. So that means we're going to write the assets up to fair value of $50,000, and whatever is left is called goodwill. So the goodwill has nothing to do with donations or charity or anything like that. It has to do with when you purchase a business and you pay more than the value of the assets, that extra amount that's left over is called goodwill. Well, the importance of coming up with fair value is that it has a bearing as to what those assets are going to end up on the initial balance sheet of the parent company. Now, we've made a lot of estimates and used earnings to help us to determine the value of the business, but oftentimes the reality is different from the estimates, right? We call this abnormal earnings. So obviously an investor is going to seek a return on their invested capital. These investors are going to have a required minimum level of return. If you're going to invest, $100,000, you probably have in your mind that you want to see at least, a certain return. Let's say you want to see at least an 8% return, for example. That's the minimum level of return that you want on your investment in the business. If the actual returns are greater than that required minimum, the result is a premium on the stock. So when actual return is greater than the book value times the cost of capital, you end up getting a premium. Now, investors use these estimates for earnings to help make a determination on the price or the value of the stock. So they call this the price to earnings ratio, but sometimes the value of the stock is actually going to be higher than the price to earnings. In other words, we might have two companies and they have the same earnings, but they have different stock prices. What could cause this? Well, first of all, current earnings are not as important to an investor as expected future earnings. So even though you have two companies that made the same amount this year, people may expect different results in the future. There's also risks that are inherent in the company. Different companies, different industries have different risks. And it also depends on the growth opportunity. A business in a mature industry, such as the airline industry, is different from a business in a growth industry, for example, the drones. So to help get a feel for the earnings and the expected future earnings, we're going to look at earnings from continuing operations, what the core operations of the business is. We call those permanent earnings. Those are the things we expect to reoccur. Income from discontinued operations, let's say we're no longer going to sell sporting goods, right? We're going to discontinue that, or we're going to shut down some of our retail outlets. Those are discontinued operations. Those are transient earnings. They're not going to be around for very long. And then there's some things that are going to hit the income statement as earnings, but they're not really earnings. They're really more like noise. For example, if we make changes using, we change some of the accounting methods that we use, and that creates a gain in earnings versus a loss. That's really not something that we can use to help us in the future. That's more like noise. So these earning surprises are basically when our reality, the actual earnings, differs from what analysts expected them to be. These earning surprises can be a good thing if the actual earnings are higher, and they can also be detrimental if the actual earnings are less. Overall, when you're considering the value of a business, taking the assets, the resources of the business at heart is not always the best way in order to determine what the business might be worth. Instead, the earnings are usually much more important. However, just saying that we want to take earnings into consideration to value the business is not enough. As we've seen, there's multiple ways of calculating earnings